Hey, Dan Passarelli here. How are you feeling today? Today, I want to talk about a specific strategy, a new topic, Topic Tuesday. And today, we're going to talk about diagonals. So, let's talk about diagonals for a second. So, a diagonal is basically any spread that has two different strike prices and two different expirations. Both have to be calls or both have to be puts. But that's it. That's the only real rule. So if we look at this option chain here, we could be like buying these 95 puts and selling these 105 puts, or vice versa. Maybe buying or selling these 100 puts and buying these 105 puts. Or we could be doing the same thing in calls. Now, a lot of the time when we're talking about diagonals, it's very, very common among retail option traders to trade what is called a call diagonal, sometimes called a poor man's covered call. So what that is when we buy a more in-the-money option, call option, that has a lot of time until expiration, and then we sell an option that has less time until expiration that is out of the money. So in this example, maybe we're buying the here, let's look at a different example. Maybe Amazon AMZN. Maybe we're buying the 24-day 165 calls and selling the 9-day 180 calls or 182.5 calls. And if we were to do that, let's model that. So buying the 165 calls with 24 days, selling the 182.5 calls with 9 days. If we look at the risk profile, it looks a little bit like a covered call, right? Except that we have some curvature here because this is a call option, which is nice because we have limited loss. With the covered call, if something crazy happens and the stock goes bankrupt, goes to zero, we can lose everything we paid for the stock, but here we can only lose what we paid for the call. We call it a poor man's covered call for that reason, because we pay significantly less. While this is $175 stock, we're only paying a little less than $12 for this position. What we're really taking advantage of is the difference in time decays. If we get rid of that, we can see that we're paying a little under 8 cents a day and making about 9.5 cents a day on this. And we're also making money on the delta because as you can see from this risk profile, if the stock goes higher, we make money up to a certain point. Now, that can work on some stocks, like, let's look at a chart here, maybe Bank of Montreal, just for example. I'm not saying that this is a good trade or anything like that, but when you see a stock that's kind of, maybe in a slight uptrend or had a little bit of a pullback and you think it can go a little higher, buying that in-the-money call with the high delta imitates the stock somewhat, and then selling an out-of-the-money call at a strike price that you think the stock can just get up to but not through can help offset the cost of what you pay for the stock. Now, it can also be interesting in stocks like NVIDIA right now. Now, again, I'm not saying that I love this trade or anything, but it's an interesting one to look at for a poor man's covered call. If you're one of the folks who is bullish on this, this can become an interesting play for one other reason. Because if we were to buy a longer term option, maybe these 24-day 885 calls that have a 57 delta, it has a volatility of only 50, whereas we can sell an out-of-the-money call, maybe the 900 strike call, or maybe even go further out of the money, maybe this 905 strike call, or even we can look at the 3-day ones. Now that I think about it, we could sell the 3-day 905 strike calls at a pretty good price, and that's because the implied volatility is high. We'd be paying about a 50 volatility for these calls and selling these calls at a 60 volatility. So we get that volatility edge, which is common in stocks where there's a lot of retail activity retail call buying activity because it's sort of a hot stock that's very expensive, and the only way that many retail traders can play that to the upside is to buy the calls, which makes them overpriced, which makes traders who are smart and able to use the poor man's covered call to their advantage. I hope that helps. This is Dan Passarelli, and before we get going, I want to make sure that you know that we're not going to be sending out emails every day. We're still going to do it for a couple of weeks, but we need you to subscribe to our social media channels, YouTube, Facebook, Instagram, LinkedIn, all of your favorites. If you subscribe to us by clicking on one of the links that's in the email that we sent you linking to this video, then you'll be able to see our videos every day on your favorite social channels. Trade smart.